Financing rental property investments requires selecting the right strategy based on financial goals, risk tolerance, and market conditions. Traditional mortgages offer lower interest rates but require strong credit and higher down payments. Private money lending provides flexibility and faster access to capital, but may come with higher costs. Hard money loans are short-term solutions suited for investors planning quick renovations and resales. Seller financing allows buyers to make direct payments to the seller, bypassing traditional lenders. Lease options give tenants the opportunity to buy a property after a set period while renting. The BRRRR strategy, buy, rehab, rent, refinance, repeat, enables investors to scale portfolios by recycling capital. Choosing a financing method involves assessing loan terms, approval speed, and long-term investment plans. Comparing multiple options and structuring deals effectively can maximize returns while managing financial risk.
Jason, you mentioned inflation earlier. And inflation, I've heard you say, can be a hidden benefit for real estate investors. How can investors leverage that when securing financing today?
Oh, inflation is not to be underestimated. It is the greatest thing for real estate investors, especially when you use financing. Now, traditionally, every investor will tell you real estate is a great hedge against inflation. We've all heard that a zillion times. And that's because the value of the property will typically outperform inflation by a small margin. But that's not really that great. Let's add two more things to it. Number one, leverage. So when we leverage our properties, we get a multiplier effect on that appreciation. So say, for example, real estate in a really good year is outperforming inflation by maybe 5%. Okay, so if you leverage that property and say you put 20% down and you finance 80%, now you have a multiplier. So that 5% differential that you were getting now turns into a 20% differential. So that's great. But wait, there's more, as they say on late night TV, on the infomercials. The debt, the value of the debt in terms of the balance of that mortgage and the monthly payment on that mortgage is constantly being debased or attacked by inflation. And this is good for us as investors because we borrow based on today's dollar value, but we pay back based on the future dollar value, which, as long as we have inflation, is lower. And I doubt there's anybody who could argue that we aren't going to have significant inflation in the coming years. There may be ups and downs in that over time. There will be recessionary periods, of course, but the long game is inflationary. And that inflation basically pays our debt down for us. I call this inflation-induced debt destruction. I know it's a mouthful, but that's really what it's doing. It's debasing and destroying the value of that debt. And if we owe money and we're the debtor, that's a wonderful thing for us because inflation is paying it back for us. Here's an example. Say, for example, just for round figures, a real estate investor has $1 million in mortgages. Say they bought, from my company, they would buy maybe 4 turnkey houses, and they would have a $1 million total mortgage value on those 4 properties. If we have 10% inflation, whether that takes place in 1 year, 2 years, or 3 years, inflation basically reduced the value of that debt by $100,000. Inflation basically paid off $100,000 of the investor's debt. So it's a phenomenal hidden wealth creator.
Very powerful. Yeah. So you can spend more, you can spend stronger dollars today and pay back with weaker dollars tomorrow.
Yeah, that's a beautiful thing.
Kathy, for first-time investors, since we are seeing higher interest rates than a couple of years ago, what do you see? Are financing options less accessible? How have things changed in 2025?
Financing is accessible, probably more so than ever, because I think the banks would really love people to borrow money. It's just that the rates are higher, but not really historically so. When I started investing, I remember my father was so thrilled when we got into the single digits. He had been owning rental property over 10% for years, since the 80s. And so anything under 10% I consider great. What's difficult is that also home prices are at historic highs. So when you have that combination, it's harder to get cash flow these days. If you're investing strictly for cash flow, it's going to be a little bit harder, and it might require you finding an older property, fixing it up, building in that equity. You might be in a less growth area. Some parts of the country just never see prices go up, and as a result, there's more cash flow, but you're choosing cash flow over growth. So understanding your strategy is really important. As far as I look at it, if you're buying for buy and hold as a rental property, the goal should be to hold, and that this is an investment property that you're buying in a growth area where the tenants are paying down your debt for you. You're getting government incentives, massive tax breaks for doing this, for providing the housing. And over time, you will become very wealthy as a result, because in time, you'll own that property close to free and clear. It'll be paid down for you, plus most likely will have gone up at least 3 to 4%. I don't know any other investment that offers you those kind of advantages.
Yeah, so define your objectives very clearly at the outset.
Just, one thing, Andy, you might want to add to what Kathy said, because she was exactly right. But she did say that interest rates are high, and that is true compared to how we got so spoiled during the COVID era. Rates are definitely higher. Yeah. Historically, they're low. They're not that high at all, really. When I got into the business, rates were 14%. Everybody thought that was a bargain because it used to be 18 or 20%. But here's the thing. What you have to do when you're really understanding the interest rate that you are paying, or really your tenant is paying for you, because they pay the mortgage. Okay, that's the idea. You outsource the debt responsibility to the tenant, but you have to subtract the cost of inflation and the benefit of the tax deductibility of that mortgage interest. So when you subtract those two things, that interest rate is really quite a bit lower than you might think. So let's take an example. Say, for example, an investor's paying 7% on a mortgage. Well, I think we listen to the government statistics. Of course, they understate inflation, but let's just say inflation is 4%. So now our net is really only 3% in terms of the net interest rate we're really paying after inflation is subtracted. Then we subtract the interest on that mortgage, and that'll give us, depending on our tax bracket, maybe 1% or up to like 1.5% if we live in the Socialist Republic of California, right? We get a bigger tax bill, so we get a bigger tax deduction. So really, in that example, someone might only be paying 1.5% interest after inflation and tax benefits. It's not as bad as you think.
Excellent perspective. Monick, what do you see in your community of real estate investing goddesses?
Or what do I see in terms of them being able to get into new properties right now?
Yeah, financing. I didn't know, for example, do you see a need for creative financing strategies if people can't qualify for traditional bank loans, things like that?
Yeah, so there are so many different options and your great little video shared some of them, right? From there's the traditional bank, but there are hard money, there are non-qualified mortgages, which are and there's seller financing. One of the things that is really interesting right now is a lot of the non-qualified mortgages, these debt service coverage ratio loans, which are based more off of the income of that property as opposed to the borrower's personal income and debt. Those interest rates are very similar to traditional bank financing. So what this allows is a lot of borrower investors who might not have been able to, would want the much lower interest rates. They're able to get into these debt service coverage ratio loans, these DSCR loans, for around 7 to 8% in a lot of cases. So a lot of these non-traditional options are becoming more affordable relative to conventional loans. So that's something that a lot of my goddesses are pursuing.
Michael, you've used the BRRRR method extensively. How can investors decide when short-term financing like hard money loans is the right choice compared to a traditional mortgage?
That's a really good question. I think it really all depends on the need and easeability and then ultimately price of those dollars. So if somebody is going to go get short-term financing, depends how fast they can get their construction project done, how fast the eventual refinance at the end of that R is going to be in the Burr method. Something that I've seen and I've personally done, and I think is a phenomenal strategy, is we've seen incredible, unprecedented appreciation over the last several years. And so people have massive amounts of equity in their either primary homes or rental properties. And so leveraging a home equity line of credit on either a prime residence or an investment property can be a really great way to access kind of your own hard money, so to speak. But you have to understand the consequences and the ramifications of not paying the loan payments back on a HELOC that could be on your primary residence. So it's all about understanding risk tolerances, understanding what the term and length of the time you need that money is, and then what the exit strategy is on the back end. That's going to kind of help us reverse engineer into what type of financing we should be using for which type of project we're doing.
And I'd just like to add on to that, that a lot of people who don't invest in real estate don't understand how quote unquote easy it is to get an investment property loan. Not from a regular bank, but from banks that specialize in working with real estate investors. We're allowed up to 10 Fannie or Freddie backed loans. That's loans that are backed by the US government. So that just kind of shows the US government wants us to own rental properties. It solves a problem. It offers housing to people, and we're incentivized for that. And you don't have to own your primary first in order to have investment property. So a lot of people don't understand that. If you're from California and you want to buy a home and it's $1 million, you might not be able to afford that. That's a very high down payment you might have. But you could forego buying your primary and rent in California and then invest, say, in Texas, where you could buy a home for $200,000, which would be a $40,000 down payment. Or move temporarily to somewhere else if you're not working at the time, and you'd only have to put 3% down if it's your primary. That's doable. So, like I said, it's never been easy, but you just have to be creative and committed. And once you get in, and once you start to see the growth, the fact that your properties are increasing in value, and someone else is paying off your debt for you. It's like I describe it in my book, Retire Rich with Rentals. Let me say that again, Retire Rich with Rentals, get that out of my mouth. It's like having golden geese, the old story, the golden goose. You have lots of these little golden gooses creating money for you while you're not actively working on that property. You could focus on your career, the thing that you do, and have these other assets building wealth for you while you sleep.
Yeah, it helps to talk to a lot of people because I want to share really quickly that several of my clients who were looking for a quick loan, they've been able to use asset-based lines of credit, where if their account is at Fidelity or Schwab, the Fidelities or Schwabs of the world also have partnerships with banks like Goldman Sachs or US Bank, where a client can use their portfolio of stocks and bonds and then get a loan from the bank. And it all happens pretty quickly with not a lot of paperwork. It gets approved, and then they have platforms that are electronic where, all parties can log in and see what is the amount borrowable and what's the rate. And then if you take the loan, you can see that loan balance and see it paid down as well. Let's go to the next segment. We're going to talk about managing rental properties.